Then comparisons are being made to Liz Truss, but is this more Callaghan than Truss? Is this more 76 than 22?
Possibly. What we are seeing in the UK, Guy, is a train wreck in slow motion. The markets have gone into a tizzy, wondering whether, Treasury 10-year yields are going to get to 5%. But what they need to watch is the storm in the UK markets, where 10-year gilt yields are likely to get there first. So what is worrying is that the pound is getting hammered as well. So this is about the markets passing a no-confidence motion against the UK every single day. The options before Chancellor Rachel Reeves are pretty strong. Either she's got to curtail spending or she's got to put up taxes. Reeves is keen to spur economic growth, so she may be averse to curbing spending, but I think something's got to give here. Raising taxes will crimp consumer demand and consumer spending, so it will send the economy into a tailspin. So both options seem unpalatable. What all this means for the UK is that traders are going to be selling first and asking questions later. Thing is, Guy, with the genie out of the bottle now, something's got to give. And the big question is, what will that something be? As the government figures out what that something is, gilt yields, rate differential versus treasuries will widen while the pound will get pummeled in the weeks to come. Whether this is going to be a revisit of the 2022 moment, Liz Truss moment, or 1976 remains to be seen. But I would say that 1976, when the UK had to borrow from the IMF, is a distant prospect at this point, especially because Reeves has got a budget update coming up in March where she will no doubt listen to what the markets have to say.
Ben, before you depress me too much, let me put the gilt story on ice for just a minute. There is a bright spot when it comes to gold. 2664 is where we trade at the moment. Do you see it getting to $3,000 maybe?
Possibly, but well, I'll tell you something, Lizzy. I'm not so upbeat on gold as I was last year. I'll admit that. Gold has taken its inspiration from the Fed's rates trajectory since the rally began. But in a situation where the Fed is going to go slow on rate cuts, gold's upside will be blunted. My model shows that the gold will reach $3,000 an ounce. But for that to happen, the Fed's benchmark rate needs to go down to at least 375. So we are essentially talking about 3 more rate cuts from here. From current indications, it doesn't appear that the Fed is in a hurry to get there. So gold will essentially be treading water until there is a turn in the US economy that is sufficient enough to spur the Fed back into rate cuts. Mind you, real yields in the US are climbing higher, which is also negative for gold, but gold is clinging on there to current levels, which shows its resilience, and the markets hope that it will eventually get the upside of possibly 3,000.